To many people, the possibility of earning money through cryptocurrencies may appear to be more accessible than they expect. Shall we dive right into this? This episode is going to dig into a subject that a lot of you are interested in, so stay tuned for that. Generating income with cryptocurrencies. No matter if you are as fascinated by the idea of decentralization as I am, or if you are only concerned with monetary advantages, the fact remains that no one takes pleasure in experiencing a loss of financial resources. The goal of everyone is to generate returns on their investments by devoting their time and energy to activities that they are passionate about or interested in. In the domain of cryptocurrencies, there is an easy way that can be utilized to earn money. A tactic that has been demonstrated to be successful not just in the realm of digital currency, but also in the realm of traditional financial markets. In this article, I will discuss a great strategy that can help you multiply your cryptocurrency investments. Currently, we are discussing the method of dollar cost averaging, often known as DCA, which is a strategy that we will investigate in further depth today. Also, by the time you reach the conclusion of this film, I will have a unique insight for you, a significant takeaway that I will not directly explain. Therefore, continue to pay attention and see if you can recognize the underlying lesson. Imagine for a moment if you had discovered XRP in 2013, a precious gem in the wide cryptocurrency world. This was an opportunity that many others, including myself, had missed out on, despite the fact that we were actively participating in the cryptocurrency industry. Assuming that you had confiscated Bitcoin or XRP at that time, keeping in mind that I had personally invested in Bitcoin in the year 2012. These kinds of opportunities were in fact real. Furthermore, despite the fact that many of you might be thinking, if only I had known back then. The topic of discussion here will be how you might make use of such tactics. Thank you for visiting your go-to location for the most recent information about XRP. Before we get into the specifics of today's great updates, I would want to make a small request for that favor. Show your support for us if you enjoy the stuff that we provide. If you want to become a member of our wonderful community, you should give that like button a good smash, subscribe to our channel, and ring the notification bell. In addition, I have some really wonderful news. Just as we are getting close to reaching the 60,000 subscriber milestone, we are getting ready to host a magnificent XRP giveaway. The participation process is really simple and only requires 3 steps. Don't miss out on the specifics. You won't want to pass up this opportunity. It is also important to remember to include the hashtag MoneySide in your comments in order to guarantee that you will be considered for the contest. Imagine for a moment that you had made the decision to put $100, which some people fondly refer to as 100 bones, into XRP each and every week beginning in 2013. Approximately $54,000 would have been the entire amount that you would have invested. Now, try to estimate how much that investment is worth right now. Yes, you read it correctly, the starting amount is $1.44 million. Isn't it stunning to look at? You should be commended for your talent with numbers. It's incredible to think that you could make an investment of $54,000 and then see it develop into $1.44 million. But before we get too excited, let's take a moment to reflect on the situation. Your investment of $27,000 might have resulted in an astounding $5.3 million if you had made the decision to liquidate your interests in the year 2018. On the other hand, if you had invested approximately $27,000 and bought some shares at the pinnacle of the market, your gains would be, to put it mildly, negligible now. The volatility nature of investing in cryptocurrencies is brought into focus by this possible situation. One of the most important aspects is timing your exit strategy, which, even after 12 years of working in the cryptocurrency industry, I still find to be a challenge. It has been proved that the theory of dollar cost averaging has the power to build wealth. Nevertheless, it also comes with its risks, particularly if you have been investing since the height of the market. What exactly is the lesson to be learned from this? In order to prevent being unduly greedy, it is essential to make sure that gains are secured along the route. The adage, "Don't look a gift horse in the mouth," is something that is absolutely applicable in this situation. There is a possibility that the method of holding on to your investments with diamond hands is not always the effective one. It is common for people to have a misunderstanding of the concept of diamond hands, which advocates for unwavering investment holding. In reality, what we are trying to promote is the concept of having powerful hands. The ability to maintain one's position during market downturns without selling in a panic at inopportune times requires resilience. This strategy is essential for investors, not traders, who need to understand that holding out for an endless period of time is not always the best course of action. In spite of the fact that XRP has been classified as the standard due to its function in bank and international settlements, it is highly improbable that it will ever become the currency that the general public uses on a daily basis. And recognizing the appropriate time to leave your position is therefore of the utmost importance. It costs dollars. A monthly investment of $100 could have resulted in a maximum gain of $1.44 million if it had been invested in XRP from the beginning of its existence in 2013. However, the true difficulty and lesson that can be learned from this situation is the art of spotting chances like these at an early stage, which needs careful research, as well as a proactive attitude. The market continues to be riddled with uncertainty and risk, which are characteristics that greatly influence investment decisions across the board, from individual retail investors to huge institutional players. Investment decisions are influenced by these factors. In the first place, this confusion is mostly about evaluating the potential dangers that are associated with stock and cryptocurrency investment. A recent meeting of the Federal Reserve and words made by Chairman Powell have only served to add to the uncertainty that already existed, particularly in light of the decision to refrain from raising interest rates. In contrast to what was anticipated, in order to successfully navigate the unpredictable landscape of investment, it is essential to have a solid understanding of the market and to employ a strategic approach. The recent decision made by the Federal Reserve to maintain the current level of interest rates was a move that was heavily anticipated nonetheless. It has left many people waiting for Chairman Powell to provide some insights regarding the forecast for the year 2024. To be more specific, there was the expectation that there would be signals regarding whether or not there will be decreases in interest rates, which would essentially ease the financial restraints that are currently in place. Nevertheless, Chairman Powell's remarks were notable for the fact that they did not provide any clear advice on future rate decreases. As a result, the financial landscape is now characterized by an increased level of risk and uncertainty as we get closer to the year 2024. As a result of this lack of information, investors and analysts who are attempting to navigate through the approaching year have found themselves in a much more difficult situation. Despite the fact that this decision does not indicate an imminent financial disaster, it does constitute yet another obstacle in the ongoing fight against inflation, the Federal Reserve serving as the referee in this figurative battle between the three parties. Market participants have been left with the impression that they are on the receiving end of a series of unremitting blows without any assistance as a result of the absence of clear signals from the referee. When trying to understand the Federal Reserve's position, it is clear that they are striving to navigate a complicated scenario. They are trying to strike a balance between the need to combat inflation and the requirement to cultivate an economic environment that is conducive to growth. This scenario highlights the difficult balancing act that the Federal Reserve must conduct, demonstrating the complicated interplay that exists between decisions about monetary policy and the larger economic ramifications of those actions. Taking into account the careful approach used by the Federal Reserve, it is evident that they are not communicating their policy in its entirety. In order to successfully navigate the ever-changing economic landscape, they are conducting a thorough analysis of a wide range of economic indicators, such as inflation rates, GDP figures, and many more. On the other hand, this presents a big challenge for those of us who buy in cryptocurrencies on a retail level. A wide range of investors, including individuals like ourselves, as well as huge financial organizations, are dissuaded from actively investing due to the prevalent risk and uncertainty. As a consequence of this concern, significant sums are not invested since the perceived risk and uncertainty that are associated with investments in cryptocurrencies such as Bitcoin, Ethereum, Cardano, or any other digital asset are regarded as being too high. This cautious approach, which has been made worse by the events that have occurred today, contributes to the already existing risk of further illuminating the seas in which we navigate. These conditions prolong the current era of stagnation that is occurring in